Close to 1 million investors poured money into the Trump Memecoin, and the numbers that came out of it tell two very different stories depending on where you were standing when the music stopped. On one side, roughly 900,000 wallets ended up underwater. On the other, the people closest to the launch walked away with fortunes. The gap between those two outcomes is the whole story. The token, branded around Donald Trump's name and image, launched with enormous hype and an almost vertical price spike. Early buyers who got in during the first hours saw paper gains that looked life-changing. But a launch that concentrates most of the supply in a small number of insider-controlled wallets is a launch designed to reward whoever sells first, and ordinary investors are almost never first. When the price collapsed from its early peak, the losses were staggering. Analysts tracking the on-chain data estimated that close to 1 million investors lost a combined $3.8 billion. These were not abstract figures on a screen. They represented real people who bought near the top, believing the momentum would continue, only to watch their holdings evaporate within weeks. At the same time, disclosures tied to the president showed roughly $636 million in earnings connected to the venture. That figure, sitting right next to the $3.8 billion in retail losses, is what turned this from a routine crypto flameout into a political and ethical firestorm. It is one thing for a speculative token to crash. It is another when the person whose brand fueled the frenzy reportedly profited on that scale. The mechanics behind this kind of outcome are not mysterious. A memecoin has no underlying product, no cash flow, and no intrinsic value. Its price is pure sentiment. When the entities controlling the largest share of tokens also control the timing and the marketing, they can capture value on the way up while the broader crowd absorbs the losses on the way down. Trading fees added another layer. Every transaction on these tokens typically routes a percentage back to the platform or the issuing entity, which means even the frantic buying and selling during the crash generated revenue for insiders. In a market where most participants lose, the house still collects. That structure explains how one side can report hundreds of millions in earnings while the other side reports billions in losses. There is also the matter of the presidency itself. A sitting president holding a financial stake in a speculative asset marketed to the public raises obvious questions about conflicts of interest. Critics argue it blurs the line between public office and private profit, and that the sheer scale of retail losses makes the situation impossible to wave away as a normal business venture. For the investors on the losing end, there is little recourse. Memecoins fall into a lightly regulated corner of the market, and buyers generally agree, knowingly or not, that they are taking on extreme risk. There is no deposit insurance, no consumer protection fund, and usually no realistic path to recover money once a token collapses. The losses are, in most cases, simply gone. The broader lesson sits uncomfortably at the center of the crypto conversation. Celebrity and political endorsements can manufacture demand far faster than any fundamentals could justify, and that manufactured demand is exactly what allows insiders to exit at the expense of the crowd. When the famous name attached to a coin is also positioned to profit from its rise, the incentives are stacked against the average buyer from the very first block. What remains is a case study in how attention becomes money, and who ends up holding the bill. Nearly 1 million people learned that a familiar name is not the same as a sound investment, and that in a zero-sum speculative market, someone's $636 million gain is built on everyone else's $3.8 billion loss. The hype fades, the headlines move on, but the accounting stays exactly where it landed.